Monday's market reopening has sent shockwaves through the global financial system. Silver prices surged to $82 per ounce, triggering a $17 billion scramble among banks and institutional investors. But this is not an isolated event. It is a harbinger of a far deeper, secretive financial strategy orchestrated behind closed doors, one that intertwines national debt crises, gold revaluation, crypto frameworks, and hidden government mechanisms. Every movement, every decision, every valuation is part of a labyrinthine structure designed to control liquidity, manipulate markets, and safeguard sovereign interests, often at the expense of ordinary citizens. The stakes are monumental, and the window to respond is shrinking by the hour.
Imagine a world where every dollar you have, every retirement account, and every savings instrument is part of a colossal chessboard controlled by unseen hands. Governments, central banks, and financial institutions have long operated in shadows, using executive orders, hidden mandates, and policy adjustments to influence global liquidity. The $82 silver surge is a symptom of this larger game, a subtle recalibration of monetary value with cascading effects across all financial layers. Banks, caught in a high-stakes game of musical chairs, are scrambling to cover positions, liquidate holdings, and hedge against sudden market shifts. One misstep, one delayed response, and the consequences ripple through commodities, currencies, and digital assets. To understand the magnitude, consider the mechanics of gold and silver revaluation. For decades, precious metals have served as a stabilizing anchor for global finance. Central banks hold vast reserves, and governments manipulate these assets to influence currency strength and economic stability. Revaluation can occur quietly or with calculated announcements, but the effect is immediate. Assets denominated in the prior valuation become unstable. Contracts tied to these metals shift in real value, and financial institutions must recalibrate exposure overnight. A pension fund with $100 million in assets tied to silver at $25 per ounce suddenly faces a portfolio recalibration that multiplies theoretical exposure to $328 million. Multiply this across banks, hedge funds, sovereign wealth funds, and insurance companies, and the scale becomes almost incomprehensible. The $17 billion scramble is merely a glimpse into this orchestration.
Historical parallels provide context. In 1971, President Nixon's decision to sever the US dollar from the gold standard sent shockwaves through international finance, destabilizing markets and forcing nations to reconfigure reserves. In 2008, derivatives and shadow banking mechanisms, hidden from public view, triggered a global crisis, exposing the vulnerability of systems most assumed were unbreakable. Each time, the underlying mechanism was deliberately opaque, engineered to protect insiders while leaving the average citizen exposed. Today, the sophistication has increased exponentially. Executive orders and digital currency frameworks allow governments to execute financial maneuvers with near instantaneous global effect, shifting trillions in value before the average investor even comprehends the movement.
The integration of digital currency frameworks adds another dimension of urgency. Cryptocurrencies, stablecoins, and government-backed digital currencies allow rapid liquidity transfers, global arbitrage, and strategic asset management. They operate parallel to traditional banking systems, often shielding activity from conventional oversight. But this speed comes at a cost. For ordinary citizens, delayed understanding or inaction can magnify exposure, while for institutions equipped with algorithms, hedge strategies, and policy foresight, the same system becomes a mechanism for wealth amplification. In essence, digital frameworks create both new traps and unprecedented opportunities. The debt landscape amplifies these dynamics. National debts are ballooning, often exceeding annual GDPs, yet governments continue borrowing, issuing bonds, and maintaining complex credit structures. Each bond issuance, interest rate adjustment, or quantitative easing measure is akin to a hidden lever within an intricate machine. Ordinary savers, retirees, and pensioners are at the mercy of these adjustments. If debt servicing costs spike or currency valuations shift due to revaluation or market manipulation, the real value of savings erodes. Imagine a retiree relying on fixed income from bonds suddenly seeing purchasing power diminished because a $100,000 investment now buys 30% less in real goods and services. The scenario is not hypothetical, it is the inevitable consequence of these carefully orchestrated financial mechanisms.
Consider the metaphor of trapdoors. Every government policy, revaluation, or market intervention can act as a hidden exit or failure point where assets can suddenly lose liquidity or value. Banks scramble not just because of market volatility, but because the foundations upon which portfolios are built are being subtly altered. Instruments that appeared secure, government bonds, pension-linked securities, or commodity-backed ETFs, can shift overnight. Understanding which doors are closing and which remain open is crucial for survival in this environment. The $82 silver surge is a clear warning. Liquidity, exposure, and valuation can pivot dramatically in the blink of an eye. The urgency extends beyond market participants. Ordinary citizens face the consequences in tangible ways. Retirement accounts lose purchasing power, savings accounts yield diminishing returns, and unexpected inflation erodes daily life. For retirees dependent on fixed pensions, even minor valuation shifts in precious metals or government debt instruments can translate into thousands of dollars lost annually. For the average household, the cumulative effect of policy-driven shifts, currency devaluation, bond revaluation, or digital asset fluctuations can mean the difference between maintaining lifestyle and financial insecurity. Step by step, the mechanism unfolds. Governments initiate policy adjustments or execute executive orders that shift the value of reserve assets, often gold or silver. Central banks respond with liquidity injections, bond purchases, or digital currency interventions to stabilize markets or redirect flows. Banks and hedge funds leverage algorithms to anticipate these movements, buying, selling, or hedging positions in fractions of a second. Meanwhile, ordinary investors, lacking access or timely insight, remain exposed, often reacting too late. The math is stark. A 50% revaluation in silver or gold does not merely double asset values. It shifts obligations, liabilities, and derivative positions across entire financial networks, potentially destabilizing portfolios globally. Analogies help illustrate the stakes. Imagine a game of musical chairs where the chairs represent stable asset positions. As government maneuvers and market shifts occur, chairs are removed silently, one by one. Only those prepared, those who anticipate the hidden strategy, manage to secure a seat. Others are left scrambling, their positions liquidated or devalued, or consider a constricting timeline. Each policy adjustment reduces the window of safe action, forcing rapid decisions, often without complete information. Hesitation, ignorance, or misplaced confidence can have immediate consequences. The integration of digital currency frameworks intensifies the pressure. Digital assets move at near instantaneous speeds, bypassing traditional banking frictions. This allows for global capital reallocation, hedging strategies, and arbitrage opportunities, but it also means risks propagate faster. A sudden revaluation of silver or gold can trigger algorithmic trades, cascading liquidations, and rapid value shifts in connected digital assets. Ordinary savers and small investors are left unable to react in time, their positions eroded by movements orchestrated with millisecond precision by institutions operating with full insight into policy changes. The consequences are broad and severe. For retirees, the erosion of fixed income purchasing power can mean drastically reduced living standards. For ordinary savers, inflation combined with asset devaluation can quietly decimate wealth over months or years. For investors with exposure to derivatives, commodity-backed assets, or digital currencies, the risk of sudden, large-scale losses is unprecedented. Ignorance is no defense. Lack of preparation is costly. So what is the path forward? Awareness is the first defense. Recognize that the $82 silver surge is not a random market fluctuation. It is part of a broader, deliberate financial strategy involving government policies, debt recalibrations, and hidden mechanisms. Second, assess exposure to assets vulnerable to sudden revaluation: traditional savings, bonds, retirement accounts, and commodities. Third, diversify strategically, considering assets insulated from government-induced valuation shifts or digital currency disruptions. Hedging strategies, precious metals, and informed allocation across multiple asset classes can reduce vulnerability to rapid market shifts. History has repeatedly proven that financial systems are designed to favor those who understand the hidden gears. From Nixon's abandonment of the gold standard to the 2008 financial crisis, each shock exposed the fragility of systems perceived as stable. Today, digital currency frameworks, executive orders, and global revaluations add unprecedented complexity and speed. The $17 billion scramble in silver is a warning shot, a dramatic illustration of how quickly markets can pivot and how ordinary participants can be caught unprepared. The lesson is unequivocal. The labyrinth is real, the trapdoors are closing, and the timeline is narrowing. Survival and opportunity depend entirely on preparation, understanding, and timely action. For those who act strategically, gains are possible. For those who remain unaware, the consequences are unavoidable. The music is playing, the chairs are disappearing, and the mechanisms are hidden. But the implications are tangible, immediate, and severe. Ordinary citizens, retirees, and savers cannot afford ignorance. Knowledge, vigilance, and action are the only defenses against the unfolding secret financial strategy shaping the future of wealth and security.